Well, joining us now is Bloomberg Best, Philip Weiss of Argus Research. He is one of the most accurate forecasters on energy stocks. Philip also covers many of the major oil companies operating in Libya. Phil, great to have you back on. When Sheila's talking about $110 oil, for oil companies, what does that start to mean for them?
Well, for oil companies, they're not going to make a lot of changes in what they're doing based on the oil price, because these are long-term projects that take a number of years from the time the oil is discovered till they bring it online. But what it does do is it gives them some extra capital that they can spend on exploration and things like that, hopefully, to find more sources of oil.
Okay, and where would they, given all the turmoil in the Middle East, if they were to get that extra capital, and as they're getting that extra capital, where would they start putting that then more towards?
The two things that they've been allocating money to right now are probably more deep water projects. I know the Gulf of Mexico has been a difficult area because of all that's gone on there since Macondo, but there's places like Brazil, there's Asia, there are some places offshore in West Africa that they can go. And then in the U.S., companies have been allocating more money to what they call liquids-rich plays, which are plays that have kind of a mixture of some dry natural gas, and they have some oil and some natural gas liquids and things like that. And there's been a lot of money going into those kind of plays as well.
Phil, what about the companies that are already in Libya, operating in Libya right now? Marathon, I think Hess is there as well. As you're hearing more and more about supply disruptions, I think the production, as Sheila was saying, is now down to 1 million barrels a day. What does that mean then? What are Marathon, Hess, what are they going through? What do they need to do now?
Well, for the companies that are there, as a general rule, with the exception of one, the tax rate is very, very high. So they're losing production barrels, but they're not really having their bottom line impacted that much. Marathon, Hess, Conoco are three companies involved in a concession in Libya that the tax rate's over 90%. So there's really not a lot of bottom line impact. They've moved their people out because keeping the people safe is probably the most important thing for them. Okay,
so for now you just see them staying the course then in Libya?
Yes.
Okay. Now, what about this whole idea of options traders betting on $200 oil? What would it take to get to that level?
Well, it's an interesting question, because for the last couple of years we haven't really thought a lot about geopolitical risk, and right now we have it weighing on the sector, and that's kind of like that unknown. So we have a combination of a lot of speculation now, and we have this geopolitical risk. So fundamental factors move out the window to a large extent. So it's much harder to estimate where prices are going to go. It's really, to me, just a guess, because we've got these factors that we can't quantify very well.
Yeah, no, you can't. It certainly changes day by day. Phil, got to leave it there. Thank you very much. Bloomberg Best, Philip Weiss with Argus Research, talking about oil.